And what you can tie the price of gold movement also back into the negative yields that we were talking about a few minutes ago.
Sure.
They've been tracking there's a new index out that tracks the level of negative yielding bonds. And it's gone from a few $1 trillion to this year it crossed $16 trillion of negative yielding debt. I think it was last week.
Right.
And at the same time, what you're seeing is investors that might ordinarily buy those negative yielding bonds are buying gold.
Right.
They're starting to move their money to gold because they feel at least gold will hold its value.
That's a good point.
So instead of giving somebody $1 to get 90 cents back 10 years from now, they're buying gold with that dollar, and they're hoping that it's still worth $1 10 years from now, which historically gold does maintain its value relative to inflation over a long period of time.
Yeah, and that's really the case for it is even if the world makes it through this debt issue, the problem, gold probably just carries along and stays as cash that it's not affected by inflation. It just kind of moseys along. In 20 years, it's the same value as it is today. But I can't say what I was going to say. If something hits the fan, then I read somewhere, in order to back the currency like it did in the old days, which is, it takes about 40% to back the gold, to back the currency. The gold price would have to adjust upward. And that would be somewhere in the neighborhood of 10,000 an ounce instead of 1,500. So it's a 6-fold increase. And this might be a dream of the gold bugs, as they call them. They've been calling for this for a long time. For 30 years I've been doing this. But there's some fairly smart people saying that it would work like that. And if it did, it would cover a lot of the pain that you were feeling in the rest of your portfolio. And it would maybe wash that out. And my thought is, even if it doesn't happen, that pitch, so to speak, is going to carry a lot of weight over the next few years. People are going to say, why not have 3%? What's the harm with 3% of my portfolio in gold, or 5%? And if even half of the investors think like that, that's a huge demand, and that alone would probably push it up quite a bit.